A new survey from Goldman Sachs shows that investors want more exposure to the $1.7 trillion private credit market. Nearly half of limited partners surveyed say they're now allocating to secondaries and co-investment strategies. It's a pretty significant increase compared to last year. Goldman says the trend solidifies private credit as an asset class within an alternatives portfolio. Joining us now with his insights on this is Jonathan Lavine. He is chair of Bain Capital. Jonathan, welcome back to The Close.
Glad to be here.
Let's just start kind of big picture. Is demand for private credit cyclical? And I ask this because given where we are in the economic cycle, right, which is either a soft landing or no landing as the Fed begins its easing cycle and maybe pauses along the way.
Yeah, this is going to sound like both, but it is not cyclical because I think that the demand is increasing at various points in time. Sometimes it increases at a faster rate than other times. But good credit should theoretically be structured to last through a cycle. And one of the beauties of private credit is it's negotiated. And negotiated credits, at least our experience, is, will have lower defaults. You'll be able to work them out. And I think as that strategy has proven out over the last several decades, but most recently over the last 10 years, I think that people have gotten more comfortable and are increasing their allocations.
Given where we are right now, how much activity is on hold because of the election and will likely kind of restart once you do have an answer to, who's in charge in Washington?
That is a really good question. I think that it is industry specific, and I think that we are all thinking through all the different permutations of the election because obviously nobody knows, and the House and the Senate also matter a lot too. Yep. So I think that there's, in the main, business as usual, but things that might do a lot of importing, things that might be impacted by tariffs, things that might be impacted by wage or immigration, those types of things people are being a little more circumspect right now.
When we talk about, though, the demand and the cyclical or maybe non-cyclical nature of this, there's also been a lot of discussion about the broadening of the investor class in the private space. You're dealing right now with a lot more individual investors in a way that maybe we didn't see in the past. Does that change the dynamics of what you expect out of demand?
I think that the broadening of the credit market is a really good thing. I think the diversity of investors is a good thing, both globally, institutionally, and including some retail strategies. What I also think is people are beginning to realize that private credit is a very big area. People used to just, private credit meant junior subordinated middle market mess.
Yeah, right.
And then it became senior direct lending and then mega. And I use as an example, just like Applebee's and Apple Leisure are three companies that have Apple in the name.
Right.
They're very different in size, dynamics, capital needs. This is true of private credit. We tend to focus on the middle market, and we do not do the mega holdco deals. We have a special situations business that does capital solution, and that's how we approach it. There's very different strategies. There's people who do only very large deals. There's people who only do senior. There's people who only do junior. And I think just like the equity markets developed, it's good that private credit's developing that way.
Is it more difficult, though? I mean, going to a pension fund or going to institutional investors, explaining to them lockup periods, explaining to them cap rates, explaining to them all that stuff, that's one pitch. You got to do that on an individual basis, or are you feeding that through advisors?
Well, I think that pension funds tend to have pension advisors who have seen this, but more importantly, because the asset is maturing, it's not new. So when I was doing this 15, 20 years ago, first you'd have to go in and do all that, explain what private credit is, explain the premium you get, explain the trade-offs on risks versus covenant and size. Now it's a pretty mainstream asset class, so at least you start with that level of knowledge and you go in and you're just explaining where in that market map your strategy fits.
What about the risk side of that? Does that need to be explained, or is that understood?
Every investment strategy, every manager should be explaining the risk, and particularly debt managers, where our whole life is focusing on the downside. I always joke, it's always raining in our world, and therefore that is part of every single discussion.
Have you ever met an economist? Because they might beat you on that.
Yeah, although economists have both it's rainy and it's sunny. It just depends on your assumptions.
I mentioned how in that Goldman survey, nearly half of limited partners saying they're now allocating to secondaries. And we've seen a secondary market for direct loans kind of starting to develop. Bloomberg reported that Scarlet Capital traded about $1 billion of the debt in the first half. Do you see more of this happening? Is this taking off?
I still think it's pretty niche relative to the $1 trillion or greater than $1 trillion market this has become. I think anything that provides liquidity to markets is a good thing as long as the disclosures are right and it's not resulting in some sort of, panic selling. The only people who are selling are people desperately trying to get out of private assets. I also think you'll see some evergreen strategies developing, which will be another way of providing liquidity where people can invest for a period of time and then their investment winds down. So once again, these innovations, as long as they go slowly, I think are good for the market.
So does that mean Bain is not setting up a desk for that right now?
We do not have a desk to do secondaries. We are buy and hold.
What do you make, though? I mean, when we talk about this idea of the broadening of the investor class and what they know, we've also seen some folks toy with this idea of ETFs and other types of products that are very common in public markets, but private markets, at least on the surface, you would think don't make as much sense. Does it make sense?
We are a private firm that focuses on the investment return, not asset accumulation. And, I don't want to necessarily opine on something that we don't do and haven't looked at.
Okay.
But for our perspective, if you're making good loans, one, it's really hard to create an ETF because, what is the index, right? ETFs are supposed to mirror an index. Are there ways of creating baskets of loans that are publicly traded or a 100 credit vehicle or something like that? Sure, that's a way to provide access to people in a way they don't have. But I think it'd be awfully hard to have an ETF that's like the equivalent of the S&P 500 or even the bank loan index, which is the 100 largest loans.
I'm curious about the role of big banks here because it's almost like if you can't beat them, join them. They've been kind of left on the sidelines here with the development of private credit and the explosion of it. And Citi and Apollo are the latest firms to team up on private credit. They have an exclusive partnership, right, to arrange about $25 billion of financing for corporate and PE clients. Would Bain be interested in setting something like that up, or is this kind of noise right now?
We have had discussions about origination partnerships, and we've had, some smaller JVs. I think that it's more of a sourcing vehicle. I think banks need to be able to provide something for their clients. Apollo has the capital to do it. I think it will start at the bigger level, and then move down market. I don't think there's anything particularly wrong with it. Firms like ours just don't have the local offices and the originators that banks do. But right now, I think it's probably going to be pretty specific to a few firms.
All right, Jonathan, got to leave it there. Great conversation.
Thank you.
Jonathan Lavine, he's the chair of Bain Capital.